Welcome to Chapter 12. And in this chapter, we're going to be talking about how we assess whether or not making an investment is profitable. Let's say we have a piece of factory equipment. We've paid for the equipment. It's kind of going along, but we just kind of maintain it here and there, and it's kind of a faithful producer for us. Meanwhile, there's this newer, flashier, much more expensive model that we could purchase that does things quicker, better, faster, all of those things. And how do we decide whether or not we're going to get rid of the old machine, which is still functioning, versus spending a bunch of money on a new machine that may work better? And so this is how we're going to undertake. Well, there's not just one method of doing this. We're going to look at multiple methods. One uses what's called discounted cash flows, and one also known as present values, and one that does not. So the two methods that do not use present values or discounted cash flows are the average rate of return method and the cash payback method. The ones which are more complicated that we'll look at use what's called the net present value method and the internal rate of return. So the entire premise behind this net present value concept is the idea that a dollar that somebody gives you today, if you just hold that dollar in your pocket and you hang on to it for 20 years, what you could buy today with that dollar will not buy that amount years from now. So if I say to you, I'm going to borrow $1,000 from you and I'm going to pay you back 20 years from now, you're going to want interest on that money, because otherwise, that $1,000 20 years from now isn't going to have the same value, and you lost the use of it for the whole 20 years. So you want to make sure that you at least get back what its value is at the time that you get it, because you could have invested that money for that whole time. And that's what the time value of money concept considers. So there are methods in which we don't use that. There'll be two that we talk about, and primarily those are used for investments that have shorter lives associated with them, where the years of cash flow become less significant. The first one we will talk about is the average rate of return, also known as the accounting rate of return. And what that is the average annual income divided by the average investment. So basically, if we've got an asset which we're going to depreciate, we need to take the initial cost and any residual or salvage value. If you think back to your straight line depreciation days, we might have a salvage value at the end. So the initial cost plus the residual salvage value divided by 2 is what's going to give you that denominator, your average investment. And so with this example, we've got the cost of a new machine being $500, no salvage value. We think we're going to get total income of $20,000 over the 4 years that we're going to use this machine. Sorry, I keep moving myself here. So we're going to calculate that denominator here. So our average investment is $250,000. And the average annual income, remember we said we thought we were going to get $200,000 for this item over 4 years, so $50,000 a year. So $50,000 a year over the $250,000. So that's the total investment. We don't break that down other than just the calculation to get the average. And that tells us that we have an average rate of return of 20%. And if we want to use that number and compare that to some standard which we've set, and if the 20% meets or exceeds what we need to get for this project, then we accept the project or say, okay, we want to look at this further. If it's less than what we expect to get from the project, then we will just reject it and move on. So why would we use this method? Well, it's pretty basic to compute. It is, of all of the methods that we're talking about, it's the only one that looks at income. The other ones, which we'll talk about later, talk about cash flows. This one specifically looks at income. A disadvantage to that is that it doesn't look at cash flows. So as we know, income doesn't always equal cash flows. Next, we're going to look at the cash payback method. And what this does is essentially says to us, okay, how long is it going to take us to recover our investment? And this will be stated in terms of time. So we've got the initial cost divided by the annual net cash flow. Note that the other one was income. This one will be cash flow. So we've got the cost of our new machine being $20,000, revenues being $50,000 a year. The expenses that include depreciation are $30,000, and then depreciation per year is $20,000. So now we're going to figure out how long it's going to take us to actually get our money back in cash. So we've got cash revenue that we're going to get from the machine of $50,000 less the expenses that we're going to take on that annually, and that gets us $40,000 per year. Now, the initial cost of the machine is $200,000, and each year we're going to recover $40,000 of that. So we're going to get our money back in 5 years. And so this becomes more challenging if you have unequal cash flows. But this allows us to compare different projects, and we obviously the projects that get our money back to us quicker are less risky for us. So we've got a proposal here that assumes an initial cost of $400,000, and the annual and cumulative net cash flows are in the chart here. And so we can see in the green that it will take us 4 years to get our investment back. Now you got all of this. We've recovered what we've paid for it. Anything in year 5 and 6 is gravy. So we certainly want to look at if we're not going to, what if this machine only had a 3-year useful life? Well, by the time it was dead, we wouldn't have even recouped our investment. So we would definitely not look at that. But in this case, not only do we get our money back in 4 years, but we get to use the thing for 2 more years, and it will continue to generate revenue after we've gotten our costs back out of it. So we always, will give preferable treatment to projects that will get us our money back more quickly, because then we can turn that around and invest that in other projects. Plus, there's less risk of loss. I mean, certainly the longer your money is out there, the more chance that something could go wrong and you wouldn't get your money back. And if we had to borrow money to buy this piece of equipment, the more quickly we pay down that loan, the less interest expense that we're going to have on this project. So again, just like with the accounting rate of return, it's easy. This one uses cash flows as opposed to revenue. What it doesn't look at, though, because we're just looking at how long it takes us to get our money back, that calculation doesn't incorporate what it does for us after it gets us our money back. So we sort of lose sight of that if all we're looking for is the payback period, and this is all we're doing in using that calculation. If in our last example, the payback period was 4 years, and we had 2 projects, both with a payback period of 4 years, they might look like they were identical. But in fact, this project had a useful life of 6 years, 2 more years beyond the payback period. If the other one only had a 4-year useful life, their payback period numbers would come out identical. It would have the same payback period, but the value to us would not be the same between the 2 projects. And I'm going to not go through these. I'm just going to let you work through these if you choose to. And I'm actually going to stop here and go on to the next video to talk about present value, because things start to get more convoluted there.